Hi and welcome to Reliance Experts series. We have with us Mr. Amit Tripathi, CIO Fixed Income. It's always been a great opportunity to understand the fixed income market scenario from an investor's perspective. So Amit, the RBI has had its policy review and what they've done is they've kept the key policy rates unchanged and also indicated that inflation may be rising. So going forward, what are your views on the interest rates?
Okay, so I don't think they have actually increased the inflation forecast significantly. It was 4.2 to 4.6 earlier. It is now 4.3 to 4.7. That's a 10 basis point move, which is not very material from a medium term perspective. Four reasons that they have cited for inflation. One is the recent rise in vegetable prices, which is seasonal and which will reverse they themselves say by Jan-Feb. The second is the oil price movement that we have seen. The third is that they see some fiscal risks in the current context, which can be inflationary over the medium term. There have been some farm loan waivers also done by some of the state governments in the past, which is also some kind of a fiscal risk only. So they said that they could be inflationary over the long term. So I think while they have cited these, out of these 3 or 4 reasons, one of the reasons which I said a seasonal hike in vegetable prices is something that the market will clearly see through, because this is most likely to reverse in the next 2 to 3 months, and the market would definitely look at the inflationary impact from a meaningful fiscal slippage, if at all. And secondly, if you further see a spike in commodity prices. Just for everyone's understanding here, while oil has been sticky above 60 for some time now, especially after the OPEC decision, the general consensus is around the 60 mark for the medium term. Base metals, which were rising for most part of 2017, have already stabilized, and in fact in the last 3 months we have actually seen some retracement in some of the key base metals like copper, aluminum, etc. Finally, to give a sense on what the RBI is looking at in terms of inflation, I think while they have revised upwards, at least the commentary that was made yesterday also clearly stated to 1 or 2 facts which could bring inflation down. One of them was this cut in GST rates of around 175 items that the government has announced recently, which will show in prices in the near term. Second is the fact that the inflation numbers that you're seeing right now have a HRA component. If you remember, part of 7th Pay Commission, HRA was also increased. That increase is going to stay till December, and then it starts reversing. Okay. So post December Jan, you will have reversal possibly in fruits and vegetable prices. You will have a reversal impact of some of the HRA inflation. You will also see some pass through in terms of the reduction in GST rates. Our own sense is that the 4.2 to 4.6 or 4.3 to 4.7, whichever number you talk about, adequately covers most of the upside risks that the RBI is talking about, and there might not be any significant move beyond that.
So Amit, some of the segments of the market are expecting a rate hike, and this is because of concerns in the fiscal slippage or the higher government borrowing. What are your views on the same?
I would here like to dissect the risk of a rate hike and the government bond yields. So it is a fact that government bond yields have reacted negatively in the last 3 to 4 months. The primary reason for that has been twofold. One, since the October policy, there has been a general consensus that we are in for a very long pause. The visibility on rate cuts is something that is not there in the immediate future, and RBI also has very clearly mentioned that sustainable inflation at around 4% is what their targets are, and they might not want to provide too much leeway around that unless it is caused by one-off or seasonal factors like HRA and fruits and vegetable prices. The second is the uncertainty around the GST collections, and the fact that the government did front load a lot of its expenditure this year meant that when we look at fiscal numbers year to date, they look to be on the higher side vis-a-vis what we have been used to seeing in the previous financial years. The counter argument to this fiscal slippage is to, one, the market always will also look at the quality of fiscal spend rather than just the quantity of fiscal spend. This year's fiscal slippage or fiscal concerns that we have today is primarily borne because of uncertainty regarding GST corrections and the fact that the government has front loaded its expenditure this year, right? So I'm sure by the time we reach March, we would be in a relatively better off situation as far as the fiscal situation is concerned. Having said that, the uncertainty regarding GST will continue at least till end of this month or beginning of next month, when we'll get some sense from the government as to whether they are likely to borrow more. The market is anticipating some additional borrowing. If it is in a manageable range of 30,000-40,000 crores, I think barring an initial knee-jerk reaction, the markets would not take it very negatively. Given that, and this is very important for all investors to understand, whatever has been viewed in other nations which have implemented GST in the past, fiscal has always been one of the better outcomes of implementing GST. So if this is just a initial issue in terms of initial GST collections and issue with distribution, etc., we should not be too worried, as long as we are reasonably sure that next year onwards the GST collections are going to be good and the fiscal issue will no longer be there. When we talk about fiscal issues and what impact can it have in terms of rate hikes and etc., I think we will get a much more clearer picture by December, Jan on this year's GST collections, and on the broader fiscal issue we will get a much clearer picture by end of Jan, first week of Feb when the budget is presented. So I would want to wait for that before forming an opinion, especially given the fact that this government has had an excellent track record in terms of fiscal consolidation in the last 4 years, and which has also been cited by Moody's as one of the reasons why they upgraded India recently. So I think from an intent perspective, I think it would be reasonably clear till now that this government is intent on the path of fiscal consolidation.
So Amit, for our investors, so which are the themes that are going to be working for the next 1 and 3 years, and where shall our investors be investing?
So given the base case scenario that we are possibly in for a long pause, while your GSECs have reacted, you have still seen a meaningful drop in GSEC yields in the last 3 years, which was aided by significant improvement in macro variables, and the fact that macro variables might stabilize around current levels, but to see that kind of a significant improvement in the next 2 to 3 years might not be that easy. So in this kind of a backdrop, clearly there is a premium for being in, or it's more advisable to be in products which deliver a higher part of their overall returns from carry, vis-a-vis products which deliver a higher part of their overall returns through movement in interest rates. To put it simply, it is more advisable for investors to stay in neutral duration products, which are products which run a duration of say 2 to 3 years or thereabouts, within those products which concentrate more on delivering higher carry yields to investors. So that should form a major part of investors' allocations. I think if we were to especially talk about a 3-year kind of a time frame, given where absolute yields are, carry becomes a much bigger driver of overall returns than what would have been the case say in 2013-14.
Okay. So could you be a little more specific in terms of which funds that our investors should be looking at it at present?
Yeah, so it depends obviously on the time frame first of all. So clearly the funds are positioned in accordance with the kind of time frame that the investors are looking to invest for. My broader sense is that if you are looking at very short term investments like 3 to 6 month kind of investments, then you should restrict yourself to ultra short term products, something like a medium term fund in the current scheme of things that we have. But if you are looking at a 2 to 3 year kind of a time horizon, and given that we just discussed about the fact that carry will be a bigger driver of overall returns, possibly products like RRSF debt or corporate bond fund are better placed to cater to investor requirements. In the past, almost for the last 12 months or a larger part of the last 12 months, we have been mentioning that you need to have an overweight in terms of the carry category products vis-a-vis the duration category products. That does not change. So RSF debt and corporate bond fund are the key allocations that investors can look at if they are looking at products in the Reliance time frame or similar products in the industry. Duration to my mind is more of a tactical play today in oversold kind of markets, especially when you are looking at a longer term pause from RBI and you are also looking at stable macros. People might from time to time look at tactical plays in GSEC and other duration products, but that's definitely not advisable as a very large part of your overall allocation, especially if you have a time horizon of 2 to 3 years.
Thank you, Amit. It was a pleasure having you with us today. It was indeed a very insightful discussion to have with you, which would help our investors invest better. Thank you. If you have any queries, you could write to us on this email ID. You could also follow us on Twitter. The details of the same are mentioned below on the screen. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.